Well, good morning.
Morning, Ed.
How you doing? All right, so it's another, I think, Thursday, isn't it? It's another
Yes.
week, day in and day out, and you wanted to kind of talk about rates or something, which is the one thing I don't want to talk
Yeah.
about. The biggest issue, and the reason I'm saying that is because there's one thing we can't control right now: what rates are going to do and what house values are going to do.
Correct. Yes. And that's where all the insecurity is coming from in the market. People are always asking the rates, and you hear the same people parroting the same things. And so I thought, let's make a video about that because we can address it right away. And I'll quote Mike Kelly from the other day too. When Mike Kelly said,
When's the best time to buy?
best times to buy is right now because you know what the rates are, you know what the market's like. And I
That's
was like,
right.
man,
That's
that-
a perfect. I heard that. I was like,
Yeah.
man, where's that been my whole life?
that summed it up right there. So
You know today, but you don't know tomorrow.
yeah. So Mike Kelly, if you're listening, say something in the comments.
Yeah.
But yeah, so I wanted
He'll say it then tomorrow
Yeah.
when he's in on tomorrow.
Okay.
All right. Yeah. So, I mean, and I kind of wanted to show one of the issues. I think it's not really, I mean, rates are we have no idea. I've seen some people say rates are going to, we're going to level off end of this year because we're going to see this whole inflation slow down and it's not going to be so bad. And then I hear people it's going to complete opposite. And the problem with that is if you go back to some of the old stuff that I know of, because I've been in this for a while, you have to be careful because, I mean, if you look at, I'm just going to throw a quick slide in here if you don't mind.
Yeah.
Let's see here. We're both here, right? Yep. All right. So this is Fed history, and I thank MBS Highway for letting me steal their stuff. But basically, it shows about inflation. We go back 30, 40, 50, 30, 40 years. This is basically the different Fed chairs and where they were. And, this is 70s and 80s right here, this whole thing. And mortgage rates were up to 18%. And you look at the Fed funds rate, what I'm getting at, and then during when Alan Greenspan was on the Fed and what he did, and the rates are between 8.5 to 5.5. And so it'd be the 90s into the 2000s. And then you have Jerome Powell now, where we don't know what's going to happen with rates, right? Inflation, we're saying right now it's anywhere from 1.5 to 8.5. Well, it's 8.5 right now. That for most places, some people say it's even higher than that. So we don't really know what's going to happen going forward. And with mortgage rates, we don't know where they're going to stop. I mean, because if you look at some of this past stuff, look at 7 to 8.5%. So right with these rates, and then if you go up to inflation, 7 to 14%, you had mortgage rates from 12 to 18%. That's huge.
Yeah,
we don't want to get here at all.
No,
and that's why they need to actually raise rates a lot faster. But you can't control what the Fed does. The only thing you can control is today. And if you can afford to buy today, you should look at, is it cheaper than renting and where rents are going to be going down the road? Because one of my videos I did, somebody was like, no, you're wrong. You should only buy when you can afford to and in a buyer's market. I'm like, yeah, great. So that means you're going to buy every 20 years.
Yeah.
It's like, I understand that you should only buy when you can afford to buy. Correct. That was the one statement he said, right? The rest of it only in a buyer's market. If that was the case, right? If you wait till buyer's market, that means the market drops, right? I don't want to go for the rake heights but basically we're seeing an inversion down here for recession. I'm just throwing that in there. So, there's nothing we can do about that. But here, what I think we brought this up a while back, right? This 2020, this is the inversions leads to recession. And if you look right here, most people didn't realize we were in a recession during the pandemic.
True.
Right. And that's what that is right here. That's that 2020.
Home,
yeah. So, and then we went crazy, right? And then the rates dropped, right? And now, now we're having these other inversions, and this is the complete opposite. So basically, this is what you see with all the recession, what happens with rates and the inversions, and you go into a recession. And we had an inversion here, went in recession, had an inversion here. Probably there's going to be a recession right here.
Yeah.
Right. And then so let's keep going.
When you put in a graph like this, you realize how many recessions we've had.
Yeah, we had a lot. And the one thing about that is most people don't understand that in recessions doesn't mean house values go down. What recessions do is, as this chart will show, mortgage rates go down when we hit recessions.
Yeah.
Right. And so this is back in 1980s. We hit a recession and rates went down. Yeah, they went down to 12.5%. But, and then look, from 80 on to 82, way up there. And then we hit a recession and they went down to almost 12 and a half. Then they went up in the 86 and then look, they come down and then they went and they come down. Recession, boom, 1992, where I'm taking people from 13 to 9 and everybody loves me. And then you keep going down here to 2002. And then you have the major recession, which was a great recession, which this one and this one was the only two in history where house values did not go up during a recession. Or because I want to say this one, they went down because that was a great recession. It was a pandemic and it was a financial crisis, which is this. You can't ever, this one here that everybody's thinking about right now is a big deal. You cannot use this to figure out what to do going forward.
Correct. Yes.
You can only use these past ones before that one. This one doesn't count. This is an anomaly because that was the problem with the housing and building more houses and and the programs and all that stuff. We built more houses than we need. So I'm going to go a couple more slides and I'm out of here, right?
Yeah.
See that these are the interest rates that I didn't have up there before. All right. So this shows you housing during all the recession, what the values are. So this is the one we were just talking about. 2008 dropped, right?
Yeah.
And then it took off. But if you look historically, housing just keeps going up.
Yeah.
Right. That's almost, if you do here down, that's not a straight line, but close enough. So don't worry about housing and recessions. Here's all right. So we look at record low inventory, 870,000 homes, right? So you keep here on TV, oh, there was only so many houses sold. It's so horrible. That's because we don't have the inventory. Where'd my mouse go? There it is.
I see
right there.
Yeah.
You're right. We don't have the inventory. Look at 2007, 3.7 million homes inventory. Oh, wrong slide. Let's go back one more. Sorry, I clicked on the screen. There we are. All right. So look at that peak, 3.7 million homes.
Yeah,
that's a lot of homes to sell.
Absolutely.
Right now we're down here. So my question to you, if you think we're going into a bubble, where's that inventory? So that in order to hit that bubble, right? And we have to get back up to here.
Yeah.
Right. You see what I'm talking about?
Oh yeah.
I just want to make sure everybody's on the same page as me. I'm sure you're not, but anyway. And then, all right, so we got this record low inventory. I got to learn to speak today. All right, this is the most important one of all. All right, so you see, this is the amount of households from 2007 to 2021, right? We go from 116 million households to 129. And what does that mean to us? That means we have 14 million more households today than we did in 2007, and we have 3 million less homes. Yep. I don't see the bubble myself, but
no, I mean, people see that, the rates are going up and they see the cost of housing going up, but
and that's so with that, what that's going to do, right? We're going to slow down the 22 to 28% appreciation, right? Higher rates is just going to slow down the amount of people buying. It's not going to make it to where nobody buys. It's just going to make it to where only so many people can afford. Because if you look at the difference in price points from a one interest rate to a next interest rate, that's a huge difference, right? And if you keep talking, I can find the chart real quick, but that's really important, right? Because let me get rid of these charts out of here. Yeah. But I'm just saying, I put on Facebook yesterday a chart of unfun facts about interest rates, and from 4.75 to 6%, it's a $400 difference in a payment, and then that moves out what you can afford. You can only afford less, right? Well, what happens if rates go to 9? What if rates go to 12? I've heard people saying this is going to get so bad that we're going to see that. I don't know if we're going to see that.
I hope we don't, because that takes a lot of our first-time home buyers,
Yeah. Well, yeah, they have to go to other states, but that's when rates were so high before, mortgages were lower. Right.
Correct. Yeah. Yeah. And I'm curious to see if there's like a chart that shows it adjusted for inflation, right? Because I know my parents back in '96 bought their house for like $86,000.
Right. Well, my parents on Roseburg, they bought it for 84.
Yeah.
Yeah. I ain't gonna see the address. I don't want you guys to go there and throw rocks at them. Anyway,
But you know, I mean, when you look at it, people say, "Man, I can't believe the median house price right now is like 450." We'll just say roughly, right?
right.
Um, but think about what the wages. You know, if minimum wage has gone up to $15 an hour, back when when my parents bought the house, you know, minimum wage was like 275. So I think it's to scale, maybe a little bit. What people are seeing is that we have, you know, this appreciation so much, you know, 20% year over year, but that's really the market recovering from 2008,
Right.
you know, from the Great Recession. And if we would have grown at an average of like 5% every year, we'd be right where we're at.
Or higher. We'd probably be higher.
Yeah.
Yeah. So I did find this. I wanted to share. So let me share that. Sorry about. All right. So impact of rising rates, right? So at 4.5, your payment's $22.95 for a 440 house, right? At 6%, it's here. So in order to have the same payment, you can only afford $380.
Yeah.
So you're talking 60 grand less for a 1.25% in interest rate.
Yeah.
So that's the difference. I mean, because you look at a 360, 18. This is principal and interest. This is just to show you that, and we're not trying to scare you. We're just trying to say this is what we're looking at. And so we're kind of in here right now. All right, I'm sorry, we're kind of in here right now. And so if rates keep going up to 6 or 7 or 8, that's just what happens. So I mean, from here, and we were lower than this, right? We were at like 2,000 for this 1440, right? I'd say that because it was 3.99 or less.
Uh-huh.
So that's where we're at. What that means though is you know what they are now. Go buy your house now. If you do get a high interest rate, I did show you that when we hit a recession that's coming, rates are going to drop because that's how that works.
Uh-huh.
Rates don't go up during a recession. They don't. They go down because they're trying to ease things, and we are going to hit that. So basically, don't worry about if you get a 5.5 today. I'm just as an example, or 6% today. Don't worry about it. In a couple of years, we're going to hit a recession, if not sooner. We have no idea, and basically, we're going to see rates drop. Now, if the Fed makes a soft landing, right, which they've done that, I think one time, then we're not going to have that recession. But the likelihood of not having the recession, we don't know, because we just, like I said, you don't know when it happens until you're in it and actually look back and, oh, we were in a recession. Yeah. Just like now, most people didn't realize in 2020 we were in a recession. But when everybody's stuck at home, that's what happens.
Yeah.
Right.
Perfect, right. Ed. I think that sums up.
Is that enough for you?
Yeah.
Did it give you a little tour of interest rates and everything?
Yeah. No, it's good. I mean, for the people who really like to see the numbers, these charts are great. I mean, there's a lot of very technical buyers out there. And, there's a handful of people that just say, oh, whatever, just tell me what it costs and show me where to sign. But most people, they want to get into the nitty gritty once they actually start buying this house.
Well, they want to know they're making the right decision. I think that's the biggest thing. They don't want to make a mistake. Right now, you're not making a mistake by getting the house at the value that it is now. It's going to continue to go up. It might only go up at 5% appreciation, right? Down in over the next so many years, because if rates go so high where this takes people out, but we're not going to go negative, unless we have so many houses come on the market and we're complete opposite and we're in a 12-month supply, right? We need 3-some million houses. We're at 870. I think we got a ways to go.
Yep. No, I see a strong market for a long time.
Yeah. Even with rates a little bit higher.
Yeah.
Yep. That just means people are making more money, and most people are making more money right now.
Yeah. People have made killer money, and people have been good at saving money too. So
yeah, they're saving. A lot of people have cash to put down. Well, I haven't seen them, but a lot of people have cash put down.
I not to string this on any longer, but I remember seeing, I think it was about 6 months ago, where they were talking about how there wasn't enough money circulating because too many people were saving.
Right.
I'm like,
so what they did is they threw a bunch of money in the market.
Yeah. But basically that tells you people are, unsure of the market. So they're going to save their money instead of just going and investing in everything. So,
and that's good. Pay off your credit card, save money, put money aside in case something happens. I mean, I have a lot of people who are selling property and they want to put it all down, and I'm telling them keep some money aside, because you never know what's going to happen.
Yeah.
You lose your job because your company decides to move out of California because the tax issue in California, and now you can't work for them anymore.
Yeah.
Right. You never know. That's political stuff that we have no control over. You just need, you do by voting, but and we'll just move on.
Yeah.
Talk to me on Saturdays about that. And so just, you have to know what you're doing, focus on what you're doing, today, buy today, because rates today, and the value of the house today.
Yep. Thank you again, Ed. And thank you, Mike Kelly, for pointing out and making it so simple.
Yeah. It's just easy.
Yeah.
All right. I want to thank everybody for watching, and I'll be back here tomorrow.